Good morning, everyone. Welcome. I'd like to call our meeting and call our meeting to order. First thing up is we have a proposed agenda. I hope you all have reviewed it, and we need to I'd call for a motion to adopt it.
Mr. Chairman, just
Hold on just a second. I recognize Mr. Hitchcock here.
thank you, Mr. Chairman. Just a reminder for everyone, we have tried to cut down on the number of folks who have access to the call. But if you could, just please try to remember when you're not speaking to keep everything on mute. And also just a friendly reminder that that this meeting is being streamed and recorded. So just that being said, Mr. Chairman.
Thank you, Mike. Go back to, we have a proposed agenda. May I have a motion to adopt it, please?
So move.
May I have a second?
Second.
Thank you. All in favor of adopting the agenda, please say so by signaling aye.
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 Any opposed? Thank you very much. We have an agenda. You all should have received the minutes from the December 2020 meeting and the minutes from earlier this year in February. I'll call for a motion to approve those minutes from the December 3rd meeting and the February 5th meeting. Motion, please.
Move to approve, Bill?
Yes, is that you, Mr. Condon?
Yes, sir.
All right. We have a motion to approve these minutes. Do I have a second?
I'll second it.
Any discussion? All in favor, say aye.
Aye.
Any opposed? Thank you very much. We have approval of the minutes. Next on our agenda this morning, we're going to recognize our folks from GRS Consulting for evaluation, actuarial valuation update. Danny White, I believe you are a representative from GRS is going to be speaking with us this morning, so the floor is yours, sir.
Yeah, as well as Joe Newton.
Joe Newton will be with us as well. Welcome, gentlemen.
Thank you. Yeah, this is Danny White with Gabriel Smith. Please let me know if I need to adjust my microphone settings.
We're getting a good bit of background, just so you know. Kind of sounds like you're outside, that kind of level. But there you go. That's much better.
Much better. All right. Thank you.
And if you just tell me next slide, I'll drive for you.
All right. Very good. Again, I want to thank Mr. Hitchcock. It's a pleasure to present to the board again. This meeting actually has some significance to Joe and I, as when we presented this meeting last year in person to the RSIC. This was our last in-person meeting due to the COVID-19 pandemic. So it's a pleasure to be back here, although virtually, and we certainly hope next year we'll be back in person. We're going to present the results of the July 1, 2020 valuation. We do valuations annually, once a year. This is the last one that's performed. It was presented to the PIBA board in December of 2020. We've got a lot of forward-looking information, and also we'll discuss some of the impacts legislative-wise on the contribution rates and some thoughts on the COVID-19 impact. If we go to the next slide, please. Thank you. For gains and losses for the largest system in the maintained by PIBA, SCRS, there was a $2.4 million less than in assets than expected. So this is based on a hurdle rate of 7.25%. So not it's not zero, but 7.25 compared to expected. And on the liability side, it was 0.2 billion. The part I want is to just drive home is it's always on the investment side. We see that as the tough job for you guys. It's the investments are always more volatile from year to year, as what we hope when we go through next year that it'll be more than expected. And from what we understand from PIBA is so far the RSIC has had a great year, and so we congratulate you for that. On the liability side, we expect they're always much tighter, much less than 1% of the liability, sometimes less than 0.5%. The only times there's jumps in the liability is if there's certain assumption changes, which there will be next year, which we'll get to. The important thing on the schedule of the contribution rates as we move down, in April, May of 2020, Act 35 was enacted, and what that did was that's more of a budgetary item, that there was a scheduled 1% increase in the contribution rate, and that was delayed enacted. So for SCRS, the 15.56 contribution rate that was in effect for FY 2020 continued for 2021. And same thing with PORS, although a different amount. The legislation is going through their budget this year. From what we understand, what we are anticipating is there to be a 1% increase in the contribution rate to get back on track to that ultimate contribution rate of 18.56 for SCRS, 22.24 for PORS. I think there's maybe some discussion about whether that contribution rate should go up 1% or 2%. 2% would get it back on track to the original schedule. 1% would put it back on track, although the ultimate rate would be achieved 1 year later than what was originally anticipated. From the 2020 vow, there's no change in assumptions or methods, but there are in the December 2020 board meeting of PIBA, they did adopt the demographic assumption changes, as well as delivered a letter of recommendation to lower the investment return assumption from 7.25 to 7. That's current to the General Assembly that's currently established in statute. So one of three things happen. The General Assembly adopts PIBA's recommendation to go to 7% or something else. Number two is they take no action, in which case the PIBA's recommendation becomes effective until the General Assembly takes action, or the General Assembly takes action to do nothing. I want to give also an update this time about the COVID-19 pandemic, what we expect in terms of, on the demographic side, the liability side. And what I look at is South Carolina population is about 5.2 million. Roughly speaking, the SCRS, or the combined SCRS and PORS, the total membership is about 10% of that. And we're taking a presumption that the majority of those continue to live in South Carolina, the retirees. You have about 160 to 170,000 retirees. In a normal year, what we would expect and what generally occurs is there's about 3,000 checks that are stopped or ceased due to mortality experience each year. When I looked last night at the deaths attributable to at least COVID-19, it looked like for the state there was about 8,600. So that's kind of to put things in perspective. So, I can't extrapolate or draw any more conclusions from that, although what I think is reasonable to expect is there could be some mortality gains that we see next year, in part due to COVID-19 for the retirees. The size or magnitude is yet to be known. A lot of them tend to be older that experience the deaths. They would also have less liability. And then in addition, what we could expect, I think the reasonable to expect after 2021 or starting 22 and thereafter, is we could see some mortality losses, as some of the COVID deaths were also related to other underlying factors. They tend to be less healthy. So, it kind of begs the question, how much longer, was their life expectancy, without COVID-19? So that's just some impacts there. I think by and large, the largest impact COVID-19 is against on the markets, state budgets, the revenues for states and employers, the impact to schools. I think those are by and large much bigger impacts to just the state of South Carolina. If we go to the next slide. So on Act 135, the contribution rate set in statute in part was in 2017, so it had built in a ramp up of the contribution rates to an ultimate of 18.56 for SCRS. When they developed that, when the General Assembly developed that, they built in margin that these rates, so to weather some adverse experience in either in the market or demographic wise. So they really wanted these rates to be sustainable, and in addition, they built in a funding period that walks down or decreases over time, and and then also they built in the anticipation that there would be an assumption change or reduction in the assumed rate of return. You know, with what they did for this in terms of sustainability, when they put a pause on this, you had the weather of the experience for 2020, and we're gonna show that it's able to weather it. But what's critical is they get back on making these contributions, get back into the scheduled increases in the contribution rates. At the end of the day, ultimately, the contributions into the system is what's going to matter most. If we get to item, next slide, please. High-level summary of comparison of the results for SCRS and PORS for those who prefer numerical values. We'll go through quickly. We have the first line is the actuarial accrued liability, the change. Then we have the actuarial value of assets. This is a calculated asset value, so we take we kind of dampen the effect of short-term volatility. The actual market value at July 1, 2020 was actually $2 billion less than what the actuarial value was. So either that gets offset by gains in future years, or that gets recognized into the actuarial calculations over the next 5 years. Got the unfunded liability on a smooth basis. The funded ratio on a smooth basis again was 54%. And then we have the contribution rates. Members contribute 9% for SCRS, 9.75 for PORS. And then we look at the contribution rate for 19. This was it continued on the extension of the 15.56 for the contribution next year that we expect to be budgeted will be 16.56, be a 1% increase. And then the calculated funding rate, just based on a 1-year increase of the 16.56, would be a 20-year funding period. So we're not baking in for this purpose for the funding period. We're not baking in all future contribution rate increases. However, in the projections we're providing afterwards or further down this presentation, we are anticipating those future contribution rate increases to occur. We have the expected contribution rates below. You had the member rate, and then you can see the employer rate below that. If you take into account benefit payments, I think last year during this time, benefit payments were about 3.1 billion. So you get about 2.6 billion in contributions, about 3.1 billion in benefit payments for some perspective. Okay, if we go actually next slide, or it's actually 2 slides later, we got projection information. We'll start with SCRS. We have the solid lines are historical, to give you a historical perspective, as well as future looking. And then we have it on the red line in terms of liability, actuarial accrued liability. The green line is the market value of assets. The difference would be an unfunded liability that the funding policy is designed to close the gap. So current projections, without reflecting any investment experience after July 1, 2020, expect to be fully funded at somewhere around 2040, 2041. On the liability side and on the investments, we're anticipating that, obviously we're building in the demographic assumptions, which were minor, but more importantly, the General Assembly would reduce the assumed rate of return to 7% for effective 2021. Are there any questions so far? Okay, let's go to the next slide. So the next slide is is kind of give perspective. How did, we did a vow in 2019. How did we project things to look? And then here we take another snapshot in 2020, and how have things changed since then? So we have the light blue, the solid bars, the columns represent the dollar amount of the unfunded liability. The lines are reflect the funded ratio. So the light blue, 2019, we saw a steady decrease in the unfunded liability. Here we are, take a snapshot 2020. And we can see where the unfunded liability is actually expected to increase some before it starts to decrease. And this is attributable to, we have a $2 billion difference between the market value of assets and the actuarial value. We're not anticipating there's to be offsetting gains or reversion of the mean to get back to offset that for this purpose. So as those investment losses get recognized in the actuarial value of asset calculation, that's where the increase is attributable to. And as those get fully recognized, then you return to the pattern of paying down the unfunded liability. If we go to the next slide, we're going to build in a new layer. So we have the same columns. The light blue, the dark blue represent the same information that was shown on the previous slide, and then we've added another layer, the orange. And what do we anticipate the impact to be next year with the new assumptions to be adopted? So this would be a demographic assumptions as well as the investment return assumption. And so you can see we're adding another layer to it. It's going to take it's going to extend the projected period to be fully funded out by another 2 to 3 years. Some of this is due to a lowering of return expectations by 0.25%. There's another part to it, and that is on the payroll growth assumption that we've recommended a decrease in the payroll growth assumption. This is so even though the contribution rates stay the same, that payroll growth assumption is our revenue, our projected revenue increase on payroll, since we collect contributions on payroll, and so we've lowered that assumption and it expectation. So to the extent it doesn't occur, or to the extent we get more revenue or payroll increases more than expected, this number will decrease faster. To the extent it doesn't, it'll take longer. So that's the other part of that.
Hey, Dave, you mind if I make a comment on this one here?
Yes, sir.
The one thing to point out here is changing assumptions doesn't actually change how this will go out in time. The reality is what's going to push it. So if you're just visually looking between the dark blue bars and the orange bars, those two have different sets of realities showing up because we have different assumptions built into them. However, if reality is a 7, so let's say they don't change the assumption, so we stay at the 7.25, we don't change the payroll growth, but reality only gives us 7, well, the actual pattern will look like the orange bars, whether we change the assumption or not. And it works the other way too. If we change the assumption to 7, well, that's what we expect is the orange bars. But if in reality we get something closer to 7.25, the pattern will look more like the dark blue bars over time. So the assumptions only change our current expectations in these graphs, and probably our decisions. But what actually happens in the future is what's going to change this graph over time. And as we showed compared to the last slide, you can have quite a bit of change in 1 year. You can 1 year's return can really change it. And so if we do have a positive year this year, you can see a lot of pullback towards that light blue pattern that we've had previously. And that's why we monitor this over time and build in smoothing and don't overreact to short-term blips. But anyway, I just want to make the point out that over time, it's going to be the actual earnings that show us what the pattern is, not the assumption itself.
Thank you, Joe. And then, to give some highlight on the assumption changes for 2021, goes up, expected increase about 1.6 billion. About 1.5 billion is due to the change in the investment return assumption, and we have about 100 million due to the other demographic assumptions. The payroll growth rate doesn't impact the unfunded liability, only the expected contributions coming in future years, the revenue stream. Okay, next slide, please. So we go in, there's a question about this pause we had last year and the increase in the contribution rate. How does that impact the fund, the system in terms of unfunded liability? And so there's a question of what difference does it make if there's a 1% increase in the contribution rate in FY 2021 to where you get that ultimate rate a year later versus a 2% increase for this next year, and then you get to the ultimate rate as originally scheduled. And so in terms of contribution dollars, we're talking about $120 million in contributions for FY 2022, or the delta, on almost a $12 billion payroll. And then so it'd be cumulative over a 2-year period. We're talking about $240 million difference in contributions over the 2-year period on the ramp up. And so initially it doesn't make a big difference, but ultimately every additional contribution does matter as you get the compounding effect, and it just builds off itself each other. So initially the difference is small, but as you can see when it gets further out, it does make a difference. And this you could extrapolate to any decision made by the General Assembly, or any decision, anything that impacts cash flow or contributions. While each difference today doesn't matter, that much in significance, over time it begins to accumulate and begin to matter. So this is just one aspect of that. Go to the next slide, please. We show on contribution rates, we have the top lines, you got the solid blue, a 1% increase in the scheduled contribution rate. You got the dotted blue line, that would be a 2% increase in the contribution rate for FY 2021. You would get the ultimate rate a year sooner. And so there's another aspect in terms of the calculated rate, or the statutes have a minimum rate based on a funding period that decreases each year until it gets 20 years. So in the 19 val, the calculated funding period was a maximum of 27 years. When we do the 2021 val, it's going to be 26 years. It walks down each year going forward until you get to an ultimate funding period of 20. Then it opens up. The significance of that is when you get to 20 years, you really meaningfully start to pay down principal in the unfunded liability. So it moves beyond more than just paying interest. You're starting to make headway like a mortgage into paying principal on that. The green line represents a baseline. So all assumptions met, all future years, what would that, what would that calculated rate or that minimum rate based on the funding period be? And that difference between the green and the blue represents margin. How much adverse experience can the system weather before the scheduled contribution rate has to increase to satisfy the minimum? And when the decision makers looked at this in 2017, there was an often reference back to scenario 5B, and we continue to use that. And so just as a proxy of some type of adverse experience, 5B represents, all right, what if the system returned 4% return for each of the next 5 years, and then 7% each year thereafter? What does that do to the calculated rate? So it increases above the baseline, obviously, but it stays below the scheduled. And then the last comment I'll make is, in terms of the calculated rate, what's the difference between going up 1% or 2%? And it's just marginal on the calculated rate. So it's important for precedence. It's important to stay to the policy. So I don't want to diminish the importance of going up 2 versus 1, but in terms of the financial impact, it's less impactful. If we go to the next slide, we got projection information for PORs. It's a similar story as with SCRS, but the numbers and numerical values are slightly different. In terms of the assumption changes, it's about 0.3 billion in additional liability due to the assumptions, and that's almost all due to to the investment return assumption. Demographic assumptions were really minor. A lot of them offset each other in terms of any changes. We also lowered the payroll growth assumption there, so you have that part of that increase is due to revenue decrease as well. The next slide, we have the same thing. One contribution rate increase, 1% versus 2% increase. Again, it's a similar story as SCRS in terms of dollar amounts. We're talking about $16 million a year, $32 million over 2 years, whether you're going up 1% or 2%. We go to the next slide. This is something where we have a divergence now from SCRS. There's, the graph setups are the same as what we showed for SCRS. The scenario is the same as SCRS. But what you can see is there's less margin, or that difference between the green and the blue is much smaller. So there's less margin or ability for the plan to weather adverse experience for PORs. And in this case, under the 5B scenario, contribution rates would increase above the scheduled contribution that's scheduled for PORs. And under the statutes also, once the contribution rate increases, it does not go back down until the plan attains, I believe it's at least at 80 or 85% funded ratio. Part of the reason for PORs being different is it's slightly more leverage. So benefits are higher for members. That provides more benefits for people in PORs than SCRS. Their job duties are different. They also tend to retire earlier. They have earlier eligibility for retirement. And so you get slightly more leverage when you compare liability in terms of payroll. So you're collecting contributions on payroll, and the liability is slightly higher. So a little more leverage effect on there. Next slide, please. On our closing comments, the 2017 reform that increased or created the new schedule or the current schedule for contribution rates, they were on the forefront. They were successful in providing that margin to weather some adverse experience. So we have definitely applaud them for doing that. You could certainly say, nobody had an idea of a pandemic occurring, but that's what they weathered. You had an unfavorable year. The state was able to put a 1 year pause and a contribution rate increase. Now that that's happened, you've taken out some of that margin that was originally built in. You kind of used it, so it's important to get back on schedule. Again, it's the contributions that are most important to the system, and we need to get back on schedule to do that. The other part, last slide. I've already hit on the first bullet on contribution rate increases. And my other comment to the last part on the last slide, page 16, is as contribution rate increases, some smaller employers, or there may be certain employers, depending on the business line, that they have tight margins, tight budgets. They're less financially able to absorb these higher contribution rates, and they may have some incentives to somehow employment strategies reduce their covered payroll. We're talking about contract employees using other means of 1099s or otherwise, but not covering, have an employment or workforce that's not covered by SCRS, so they don't have to pay the higher contribution rates. This is something we've talked to PIBA about for a few years now, to be on the forefront about. It's something I know they're monitoring and looking at, and at some point they may introduce some action or propose alternatives. But that's something to watch for as contribution rates increase. It's just inevitable as pension costs go up. So this concludes our presentation. We certainly open the floor to any questions from the board.
Mr. White and Mr. Newton, thank you very much. Does anybody on the any commissioners have any questions for our folks from GRS?
Not for GRS. I'm just kind of curious, Mike. I mean, obviously, a lot of this involves stuff that's outside of our purview with the legislator. I'm just kind of curious what the conversations across the street feel like and are like right now.
I've been over there, and Peggy might be, as far as on the contribution increase, whether they're looking at one or two. Peggy might be a little bit better informed on that than I am. My feeling is at least on the assumed rate of return in the conversations that I've had, I think that there's a commitment to allow that to go into effect. I don't think it's my understanding that General Assembly is probably not going to act necessarily on that and just let the the new return assumption go into effect. I've had conversations a good bit with different kind of subsets and trying to incorporate the concept or push the concept of investment risk and kind of the risk that volatility plays in all of this. The great thing about the funding policy is that we've back in 2017 we shifted kind of the eggs. If you think about the eggs in the basket, we really kind of shifted them back to the basket that we can control, which is the contributions. Really, when they were much more into the basket of the part of the plan that we can't control, which is the investment return. So, I think that they're definitely aware of that risk. I believe that they're committed to getting back on track with the contribution increases. It's just a matter of whether it's one or two this year. So, Peggy, you have any additional color on that?
Sure, Mike. The governor's budget did include just the 1% increase, and yesterday Ways and Means adopted the 1% increase in their budget as well. So that is what I expect to see this year. There has been, from my conversations with them, commitment to continue those increases. It just means that we'll ultimately get to, as Danny mentioned, the 18.56% 1 year later. And while that does have some impact, given the impact of COVID to the state and not having a budget last year and only a continuing resolution, I think that is their compromise, is that they're committed to continuing the 1% increases each year, but they just do not have the ability to increase it by 2% in this year. So I feel very good about their commitment to continue the increases. I do want to make a comment about the employer contributions. That is something that we've had numerous conversations with GRS about. We are concerned about. I've had numerous conversations across the street with key legislators about that, and they are aware of that. You may recall that there are several pieces of legislation out there that deal with some relaxation of the earnings limitation provisions. In all of those cases, key sponsors of those pieces of legislation have been consistently supportive of including some provisions that would also protect us from those employers trying to avoid paying their share of the contributions by, as Danny mentioned, treating employees as 1099 employees when they, in fact, have not changed the job duties that are underlying that. So it is something that we are concerned about. We continue to monitor that issue, and we continue to engage the General Assembly with it.
Can I ask you one other question, Peggy? And it may be too early to know, but I'm kind of curious. Have we seen any change in retirement trends because of COVID related, just specifically with like teachers and age? I mean, obviously a lot of the headlines are from other states, but or is it too early to know? Because I know like teachers get their contracts, maybe closer to the school year. I'm just kind of curious if we're anticipating any shifts because of the demographic makeup of the teacher base, right?
Sure, and just a couple of comments on that. There are a lot of reports across the country about systems, especially like CalPERS and CalSTRS, showing significant increases in number of retirements. We ran a query yesterday just to compare our retirements this year compared to last year. And we really are not seeing in the data so far that impact, but as schools get back to in-face 5 days a week of schools, we very well may see some going forward. So I don't want to imply that we won't see that. I'm just saying we haven't seen it yet.
And if we were to see that, how would that flow through? Just I'm kind of curious. I mean, does that, because they might be retiring earlier than expected, but presumably they wouldn't have accumulated as much of a benefit, right? Like how would we expect that to flow through if we were to see that?
Well, I could ask Danny and Joe to respond to that, but my comments would be, we do that every year in the actual evaluation. You know, and if you have some people who retire earlier, well, they retired this year, but they're not going to be in the people that we expected to retire next year. So there is going to be some impact. It may offset by lower benefits when somebody retired earlier. It just depends on the data. We look to the actual valuation every year to tell us what that impact is. But Danny and Joe might have some more artful way of saying that.
Yeah, thank you, Peggy. Generally speaking, retirement eligibility is generally most people satisfy the 28 years of service first. And generally speaking, when somebody retires shortly after attaining that 28 years or starts their benefit at 28 years, that's the most valuable age to start their benefit. While the benefit's smaller, it's paid over a longer period of time, and that's where the additional value comes in. That kind of plays into some of the earnings limit discussion that has been going on across the street from you guys, changing the earnings limit, whether it has a cost or not. And it goes back to the working retirees rule that were in effect prior to way back 2011. And it is a cost to the system generally if people retire earlier at an earlier age than they would otherwise. Now, if they retire and they completely leave the workforce, that's one thing. That's the purpose of the retirement benefit. But if these people are retiring and somehow find a way to come back and quite honestly, just double dip, work, come back to the workforce, continue the retirement benefit, and collect a salary to increase their financial means, which we don't blame them. That is a cost. That is an additional cost to the retirement system, because what it is people are using the benefit as more of a reward for 28 years of service rather than the purpose of it is to as a means of income when they decide to leave the workforce.
And so just one follow-up comment to that. We have been very vocal with the General Assembly in explaining to them the ramifications of relaxing the earnings limitation because of the very comments that Danny just made. There is a significant cost to the system if you entice people to be able to retire earlier so that they can come right back to work. The General Assembly has been very good so far, in my opinion, in trying to limit that to very specific, narrowly focused issues like school resource officers in the schools, or some very limited, narrowly focused exceptions during COVID. But there has certainly been a lot of push this year to remove the earnings limitation. Danny and Joe have provided the fiscal impacts associated with that. We've been very vocal, as I said, in sharing that with the General Assembly. And it is certainly my hope from my conversations with them that they are not going to take any action that inadvertently causes a cost to the system that they are not prepared to pay for.
Thank you. Sorry, it takes me a while to find the mute button there.
Danny, I had a question. When one of the things that we kind of think about is, the impact of investment risk and especially volatility on on the system, we're either whether it's 7.25 or 7%, there's a significant delta between that and a risk-free rate of return. And kind of thinking about to the extent that the 5-year smoothing period helps absorb some of that, some of that variance you see in return. But also, thinking about, is it better for the system when we're thinking about how we're structuring the portfolio? Is it better to go, I guess, to try to reach for more return with more risk, which really creates more uncertainty of outcome? Or is it more beneficial to think about it more of, potentially less return, but a greater certainty? Do you guys think about that in any way or see any benefit to either of those pursuits?
Yeah, well, that's the ultimate question. And I think it's one of those things that you also have to take into account where you are now, like, the history, how you got to where you are now. If you could start from scratch and put some sort of negotiated agreement together, you might come to one set of balance in that exactly the issues that you're discussing there. And so, but you have to actually, in their case, you have to take into account where you are in the history of this program. And so that's one way of saying if there actually is risk in not taking the risk. It all depends on how you're defining risk. And so, if the employers / the members see risk as needing quite a bit more money or having the benefits cut, that's kind of what they're looking at. Well, there's risk in getting more defensive. Now, you could say, well, but if that's where we're going anyway, then we need to recognize it. Absolutely. And so that's where you get in this big circle, of wanting to get defensive. And I think one of the options, and I'm sure you guys know way more than we do about, is, well, if you wanted to get defensive, what even options do you have that would even get close to the 7% that you're trying to get to? So I think one thing to take into account, you have a very good funding policy going forward. You get stable contributions. You know what they're going to be within a very tight range. You don't have a lot of even monthly variation in the amount of money that you collect. Your payouts are very dependable. So your cash flows on a monthly basis are very consistent and will be like, you're not going to get. We have clients where we recalculate the amount every year that's going to go in, and sometimes that's even done on a dollar amount basis. So not only can the dollar amount itself change, whatever time of the year the plan, this plan sponsor decides to contribute, it can change. Well, that's taken a lot of advanced cash flow management on its own to deal with, and you guys in general don't have that to the same degree. So. So that's one thing. The second thing is actually where your funded ratio is actually puts you in a little bit of a beneficial leverage position. It would be one way to think about it. The better funded you get, you actually end up with more assets per unit of payroll or liability. It actually increases the uncertainty and the volatility. So where you're at right now, you're running between 50 cents and 60 cents on the dollar of assets. That's kind of a way to think about leverage compared to the payroll and what you're trying to accomplish. So I think you have some things going for you that would, if you're just trying to compare two options and one of them is more equity-based, more growth-based than the other, and you're trying to think, well, do we have room to consider this? That doesn't mean you make the answer is yes, that you do it, but do you have room to consider it? I think you do have some things going for you that would allow you to consider those things. The 5-year smoothing is one of them, but really it goes beyond that because the funding policy is so set and it doesn't change. That should give you a little more flexibility that even if we have, and as Danny showed, even if we only earn 4% over the next 5 years, for SCRS, that still on its own is not expected to trigger a contribution change. That that's given quite a bit of room to try to get the 7, or even close enough that it works out. If your funding policy, if we only do 6 over the long term, your funding policy will cover that. That's not going to. Now it's going to take longer. I mean, I'm not saying that's giving the same outcomes that you currently want, but it's also not falling apart on you either. And so that's kind of one way to kind of think of it, because that question comes up a lot. Is it better to get more defensive? And again, I think if you're starting from scratch, or if you could somehow separate the membership and say, okay, for younger people, we're going to invest differently for them, planning that down the road we can be more defensive. There might be some strategies to think about, but you have to make these decisions in the world that you're currently in, which is going to be very difficult to get very defensive without basically causing the very thing that you're trying to keep from happening by being defensive, and which means needing a lot more money, benefit cuts, that kind of stuff. So anyway, hopefully that helps you kind of frame an answer there.
I think one of the things that's been certainly beneficial, because with the funding policy, is the increased liquidity, and bringing in that negative net cash flow number. I mean, that was certainly beneficial in helping us maintain liquidity during the COVID shutdown and the market events surrounding that. So I mean, that's certainly beneficial.
Absolutely.
Absolutely. Yeah, I agree with Joe.
Go ahead.
And I agree with Joe. It's really stemmed on the contribution rate. It's the funding policy. It kind of removed the contributions tied directly to a funding period and an actuarial rate where you have some margin. So it's a benefit to the RSIC to take on some risk. Mike, what you mentioned is actually was a point I was going to raise up, that from what I heard from other systems during the market collapse that occurred 2007, 8, 9, that one of the struggles they had was actually liquidity risk. They had some money tied up in private equity, and that required some additional cash contribution, cash infusion, and some systems really struggled with that. I don't know where RSIC's positions on those type of illiquid investments are, but that's something actually to take into consideration, not just the volatility, but liquidity risk.
Yeah. Well, I mean, because you can, if you have sufficient liquidity and you don't have to sell when assets are impaired, then you can weather the storm, as long as the capital that you're invested in is not destroyed by whatever market event occurs. So I mean, it gives you the benefit of allowing those assets to recover in value.
Yeah. Very good questions.
All right, folks, any more questions for our guest from GRS this morning?
Yes, Mr. Chairman, this is Bill Condon. I have one.
Go ahead, please, sir.
And in a way, it tags onto this prior conversation. But I think in both of the last 2 years, the governors proposed to close our plan, the defined benefit plan, to new entrants and put new entrants in a defined contribution plan. And I'm not making a value judgment on that. That may be the best long-term decision for the state. But in the short term, and short term may be 10 or 20 years, but in the short term, it seems like that's going to include more cost. That's going to incur more cost to the state. So as fiduciaries, I certainly would like to make sure that information, that additional cost information, is available to the legislators and in their hands before they make any such decisions. So I guess question A is, and maybe this is for Mike or Peggy, is what's the status of that proposal, and do you think it'll ever go anywhere? But no, and number two is that this kind of additional cost information either being prepared or can we as fiduciaries, get that information prepared quickly when needed, hopefully before it's ever addressed in committee.
Bill, I can start, and then anybody else can certainly join in. Back at, I guess it was 2 years ago now. It was about this time 2 years ago when both Peggy and I presented to the Senate subcommittee of the Senate Finance Committee on this, and we had those. We provided them with what we consider to be the potential costs associated, and from our perspective, the risks to the system from an investment standpoint associated with closing the system. So that's information that they presently have. I mean, it obviously would need to be updated, but that's something that if there was ever a proposal that was gaining any real degree of traction, I feel like that's something that we could put together and provide for them fairly easily. There's a lot of work that's involved, and I'm not, trying to short sight that, but that's something that we've already done, and I believe that that's something that we could, provide for them with relatively quickly, should we need to. I don't necessarily see that as an imminent issue presently, but it is something that the governor continues to be interested in and continues to push, but that doesn't seem to be from a legislative perspective, doesn't necessarily seem to be on the front burner from where I sit. So.
Yeah, and from our side, I mean, your rational thoughts while ago on it are exactly where it's our position as well, that it will decrease the amount of investment earnings you can generate over time, because you're going to have to eventually be required to get more liquid. Even if you want to have the same, we'll call it risk tolerance in quotes, you still have to get more liquid, and that alone, you just take out your 3 or 4, 5 top illiquid asset classes, you impact your expected return quite a bit.
Yeah.
And that has actually been an irrefutable argument the last decade, when it's brought up, and that's true. And so what's going to happen? Policymakers basically would have to just say, okay, we understand it costs. We're okay with that, because we want to do this other thing so much that we're okay with that cost. And so that gets back to the original point, was let's make sure that they know what that is. Let's make sure that it's fully disclosed, it's transparent, and they can deal with that and make a good decision. And that's the type of information we try to provide. But for sure, if you shut the plan off, it's a cash flow model first is what you're trying to manage. And so you change the inputs of that cash flow model, it's going to limit your investments and eventually the amount of investment earnings. And so if you're going to pay out the same amounts to those individuals, it's logical sense that you have to it's going to cost you more. So it's just then becomes win, right? Who's going to pay it and when? And we think the best approach is, well, your current actives, you really need to try to get as much of that money in before they're gone as possible, from a intergenerational equity and a tax. These taxpayers are receiving the services, therefore it should be paid for now. But that's always a negotiation for sure.
Yeah, Bill, and that's one of the things that we very much attempted to show them, is that the danger in and some of this depends on how much of if you shift everybody to a DC plan, how much of the contribution stream goes with that next employee, right? Because ultimately the system doesn't necessarily care where the cash comes from; it just needs cash to pay benefit payments. When we think of negative net cash flows to the system, we think of it as employer and employee contributions on a yearly basis, but combined. So, to the extent that you start deferring those contributions to another system, and especially the employer piece, which really is in place to address the unfunded liability, which is a liability that exists today, right? We're just looking at the discounted value of it, of a stream of benefit payments over time that have already been accrued. You start shifting that away, then there's a much bigger net negative cash drag on the system. And as Joe was saying, that requires us to bring in the overall duration of the portfolio, and as a result, the return expectations go down significantly. And so you ultimately have to start eating into it's not just investment earnings, you're starting to eat into the principal in order to pay benefit payments. So, in the way that we modeled it was, what are the chances of you get to pay as you go, and how much is that going to cost you? Or, and ultimately what we found is it's cheaper, to get to fully funded than it is to close the system, because of the additional years of increased contributions that have to come from somewhere that you would have to pay into the system.
Great, thank you, guys.
All right. Any more questions or comments to the folks from GRS or to Mike or Peggy involving this? Okay, hearing none. Thank you, Mr. White and Mr. Newton.
Thank you.
We appreciate your work on this.
It's a pleasure to present. Thank you again.
All right, folks, next up, we have the chair's report, and I have no information for you at this time. And next up is the committee reports. Recognize have we had any committee meetings, Mr. CEO?
I don't think we've had any since
We haven't had any since our last commission meeting, have we?
I don't think so.
All right. So there's no information to be gleaned there. Next up, we are to hear from our folks from Makita. Take it away, gentlemen.
Well, and we have it's Allie, you and Leroy are on, correct?
Yes, I am, and
Okay.
I think Leroy is too.
Very good. So if you guys just tell me to next slide, I'll drive for you.
Perfect. So I'll start out first, and I'm going to go through some of the logic and some of the math behind our capital markets expectations. And then Allie will go through and talk about the expected direct impact on the RSIC portfolio. So if you can flip over to the next page, Mike, that'd be great. So here, essentially, this is an exercise that we go through every year. In January, we review what's happened in the most recent year and take that into consideration for what's expected for the coming year. And then we take this out 20 years is what we look to do. Essentially, there's some factors that go into this, but I thought it would be helpful just to give you a little bit of a backdrop, because this exercise is, I think it has some recency bias to it, in that when we look at returns, it's not really one that takes into consideration a lot of trend, if you will. I would say if I were to put a characteristic here, it would be more of a reversion to the mean type of scenario in terms of our putting together these expectations every year. And if we just go back to the last 3 years, you may remember in 2019 we were coming off of a really disastrous fourth quarter, which essentially wiped out a lot of the returns for 2018. December was particularly dark and black. So after that happened, the numbers for 2019 were revised up as compared to 2018. And then, as you may recall, in 2019 also, we had a a very good January and a very good February. So we essentially had a V-shaped recovery, and that made us, the committee, the group, the capital markets group, want to go back to the blackboard and maybe revise again, because the recovery was so abrupt, essentially bringing back all of the market value that was wiped out in that fourth quarter. The decision was made in 2019 not to do that. Fast forward to 2020, with a great 2019, there was a slightly downward revision in expectations across the different asset classes based on what happened in 2019. However, we had an event in March where the economy essentially shut down, and that really impacted the markets in a very negative way. And for the first time since 2008, during the global financial crisis, we actually did go back and revise our expectations, and they were revised downward again mid-year. And that was the first time in 12 years we had done that. For this year, we're coming off of a really historic year for returns in spite of what happened last year. And you may recall in March, for the first time, we had a 30-day period where the S&P 500 had both a bear market, which is a correction of 20% downward, and then a bull market where it corrected by 20% and moved back. And all of that sort of lost in the equation based on what happened during the following months, where really for the equity markets, we only saw some volatility in September and October, but the year finished up really strongly. 2020 was really interesting because it wasn't just a year for equities. It was a year also, in spite of the complacency and a reach for risk that we saw, appetite for risk, there was still some fear in the market. So there was a lot of buying of protection during this time period. So you had the yields for bonds went down as a result of that. But if we were to look at what was driving the equity markets, it was essentially the FANG stocks. You know, you're looking at Facebook, Amazon, Apple, Netflix, Google, and Microsoft. At the end of the year, those stocks had done so well based on the fact that everyone was working from home, watching movies at home, ordering food from home, on the internet nonstop. The tech stocks just did incredibly well to the point of accounting for 25% of the S&P 500. And you look at the S&P 500 for the year, it posted a return of almost 13% at 12.7. And if you look at the last 6 months, which takes out the volatility that I just mentioned in March, you had a return of 17%, 16.9. And if you go further down, you know, that's mostly large cap. And we did see there was a wide dispersion between growth and value with the tech stocks doing so well. But at the beginning of the year, for most of the year, there was a dispersion between large and small cap. But small cap actually ended up finishing with a 20% return for the year, up almost 40% during the last 6 months of the year. And as I mentioned, bonds also had a good year, finishing roughly with core bonds finishing the year at roughly 8%. So when we look at all of these factors, we take into consideration interest rates, credit spreads, and equity prices, as mentioned here on this page, when we go in to do our expectations. And with all of those things that I just mentioned, we had a downward revision for just about all of our asset classes for the year. And not to sort of give you the solving of the mystery here, that impacted what we expect for the RSIC portfolio, a downward revision of 66 basis points to get to a 6.6% return versus a 7.2% return as for last year. And I will say, hold on one second. eventually I'll get rid of the landline here since I never use it. But I will say when we look at exercises like these are 20-year expectations. They're compounded, so it takes into consideration volatility, and these numbers are rarely right for any one year, but it is something that's expected over the long term. And I will say, when we look at these, there is a recency bias, as I just mentioned, and there are some factors in here that will make you not want to use this as a sole data point. So if we can move over to the next page, please, Mike. And what we use these different asset class expectations for is to go into our mean variance optimization. And just by that, you see the mean variance. This is going to take you back. There's going to be a reversion to the mean part of this when we look at it. And it's very important to understand that these are all simulations. These are all outputs that have some subjectivity to them as well. And this is one of the reasons why we do this once a year, every January. And once again, it's based on how the year ended. And the factors that come out of these are expected returns, expected volatility in the form of standard deviations, correlations, how these are going to react, different asset classes are going to react with each other. But I think the most important part on this page is that these pieces all have a quantitative factor to them, but there's also a qualitative factor to them as well, in that this group sits down and it debates where we think certain asset classes are going to go, what kind of story or narrative that the numbers are telling us. So we move to the next page, please. And we go through this process for each asset class. And I'm going to go through, as I said, some of the math that we do and some of the logic here. This is something that we can literally spend 4 or 5 hours on. I would not inflict that on you guys here, but it is something that we as consultants talk about at length. For instance, I sit on the investment policy committee, and this is a strong topic of debate for us because it really affects our clients in the sense of expectations. So there's a lot of very careful deliberation that goes into each of these asset classes individually. And now we're at a point where, having added in, I want to say 7 or 8 new asset classes last year, we're now at a number of 86 different asset classes. Broadly, there's some broad asset classes, and then there are some sub categories that go along with that as well. Next page, please, Mike. And here, as you'll see on this page, each asset class really has 2 or 3 factors that are evaluated at that point in time. And 3 key elements that emerge for each of these are income, growth, and valuation. Those are the 3 key factors. If I were to summarize it, these are the 3 key factors that go into each of these different asset classes to come out with a new number for each year. Following page, Mike, please. And what we do for each of these as a basis is look for different methodologies of prognostication or a predictor factor here. And as you will see, these are regression analyses. And for the bonds, the numbers tend to be right on for our 10-year expectations. So when we build these models out, we initially start with the 10-year. And then we build on to that, as we'll see later, to get to the 20-year, which is what we use for well over 90% of our clients, maybe even more than 95%. And I sit on the board for a pension fund here in Massachusetts. MassPrim, we're roughly at about 90 billion right now. Their consultant uses a 30-year number. And as you add on these years and you add on risk premia, the numbers become more attractive, moving from 10 to 20. The numbers become, really attractive using a 30-year. I don't agree with the 30-year methodology. I think the 20-year is one that's sort of more appropriate and pertinent. But here, once again, we start out with looking at these factors. So for bonds, pretty much the yield to worst that you get now will be the return that you get 10 years from now. And you see a very high R-squared number and a very steep slope. Similarly for cash. If you move over to real estate, not so effective. See a very low R-squared, and you'll see that the y-axis doesn't really match up all that well with the output on the x-axis. However, for equities, it's a little bit different. The Shiller, what that uses is an inverse relationship, and this is actually pretty accurate too. Uses an inverse relationship, meaning the higher the PE factor is, the lower the expected return is for 10 years. And those numbers come out pretty close. But once again, these are just starting points. These are not the only pieces that we look to put the puzzle together. It helps to set the expectations. And when we're looking at what's going on now, say for equities with PEs being so high above the mean in terms of standard deviations above the mean, that calls for a downward revision. So if you could flip to the next page, please. And as I mentioned, we start out with the 10-year, we move to the 20-year, and one of the things that makes the 20-year numbers more attractive is the addition of the risk premia, as I mentioned. But each asset class, once again, is looked at very separately. And as it mentions here, the shorter history calls for more art, if you will. The ones asset classes with the longer history, we feel we have a longer runway on in terms of figuring out what really does make sense. So there's less debate there. More of the debate hinges around the asset classes with the shorter time periods. And, as I said, there's a lot of debate following what happened in 2020 and how that would impact how we look at this. Next page, please.
Hold on, Leroy, can I ask you a question?
Sure.
Yeah, and kind of, maybe just a little bit thinking more about Makita's thoughts around the difference between, 20-year expectations and 30-year expectations. From our perspective, I mean, I think when we're thinking about the average working life of one of our beneficiaries, right? And,
right.
And we're thinking about this kind of more if we're looking at how do we manage the plan in a way that kind of matches up with that to a certain extent. Right. It would seem that a 30-year forecast would more match up with that average working life, and kind of more of it when we think about kind of how we're thinking about our liabilities, over the course of 30, it would seem like that would be a better match. And just wanted to get your thoughts on that. And then two, if you were doing 30-year forecasts rather than 20-year, do you think that would impact the kind of the year-to-year volatility in the expectations?
Answer the second question first. The risk, I have not seen that. I've seen us, at MassPrim, we've used a 30-year. I'm going to say I've been on that investment committee now for 16 years now. And really, we just started using that 30-year number when it didn't look like had a snowball's chance and where to make our assumed rate of return. So there was some creativity that was done there. And I bring this up at every February meeting when we go over these returns, that the 30-year seems to be a means to getting to the number. I've not seen a lot of change in the expected volatility with that, but you would expect, with a higher return, the standard deviation factor does go up. As we'll mention here, that's one of the pages that we do here. I think the 30-year number has too much layered onto it, and this is me personally speaking. And I brought this up. You guys may remember Frank Benham. Frank Benham runs this group, and I brought this up that, hey, I've seen this go out 30 years. What are your thoughts on that? And Frank, being the math guy that he is, I don't think he likes the art part that you would have to layer on the 10-year, and then you have to layer that also on top of what you've done for the 20-year. So that look, when we look at all of these things, these are all simulations, and as I said, these are data points that are nice to know, but not one that you should hang your hat on, not one that you should look at and try to figure out how to dial up risk to get a higher return, because there's no guarantee. Once again, these are, smooth out, geometric, 20-year expectations taken into consideration, volatility, and these are a single data point that you use in portfolio construction and should not be one that, you said, hey, you gave us this model and we put, 5% more into private equity. Obviously, that's not a realistic case because it will take you, 3 to 4 years to get 5% more in private equity, given all of the mechanics there. But I think the 20-year does give you a better sense of the historical piece, which is, if you look at the 10-year, that's mostly driven by historical returns and a reversion to the mean. It gives you that piece where you could come in and add in the risk premium for the additional 10 years. And what I will also say, Mike, is when we look at these exercises, we'll talk about the standard deviation and correlation a little bit later. On the return side, we are very conservative. So when you look at these numbers, that the outputs for each portfolio and asset mix that we put into play, these models do not contain manager alpha. So if you've been pretty good at manager selection in terms of, and especially in the alternatives, where that matters a lot more than it does, for large cap equity or core bonds, we don't consider that as a part of it. So if you're good on the manager selection, you should, in your head, sort of add on some more basis points to the expected return. And for this exercise also, Mike, we take out fees for the expensive asset classes, like hedge funds and private equity and private real estate. Those fees, those returns are net of those fees. So they've been skinnied down a bit, and in cases where you've managed to negotiate fees and get a very attractive fee structure for the portfolio, this may be understating your return by overstating what the fee is also, because that's done on an average basis. I hope that answers your question. Or
Yeah, that's good. Thanks.
Okay, great. Okay, so if we could turn to the next page, please. And I'm not going to bore you with all of the math here, but essentially when we look at equities, you know, the expected return, the equation is the dividend yield, the earnings growth, the multiple effect, multiple expansion piece, and the currency effect for international investments. That's the simple piece here in terms of getting there. And then we go in and we look to do the reversion to the mean part that I just mentioned to you, that really took apart a significant part or role in the returns being adjusted up in 2019 and adjusted down in 2020 and 2021. Next page, please, Mike. And similarly for the bonds, you know, we went through and I showed you the yield to worst that's used for the 10-year expectation. That's the simple math there. But for each, as I just mentioned, there's a lot of care given to all of the different asset classes. You know, for TIPS, we look to the break-even inflation rate. And as I just mentioned, for international equity, adding in the currency effect, we do that for bonds also. So for each of these, there's a starting point of the mathematical equation to get to that expected, and then the conversations revolve around the qualitative effect. Next page, please. So those were the returns. For standard deviation, just like with the different asset classes, there's a historical component. We start here with the 15-year, what the actual standard deviation was, and then we adjust for skewness. And skewness, you know, with the negative skew, which essentially means, you know, the bell shape moves over to the left, where there are tails, where there are negative events have taken place. And we add that to the standard deviation, the 15-year, to come up with the assumption here. And you see for bank loans, there's an expectation there of a 9. For private markets, there's a smoothing effect that takes place. And similarly, as we move down to the correlations, the interactions, 15-year as a basis, and then we go in and add in the qualitative factor. And as I mentioned, there's a very conservative nature on the return side, and we do this also on the risk and the correlation side. We increase the standard deviation and the correlations based on these qualitative conversations that we have together. So that conservative approach, once again, should be considered when looking at the overall outputs. And as I mentioned, you know, on the return side, the no manager alpha and the fees being taken out, that should be something that should be taken into consideration when looking at the overall numbers. So those are the logic, those are the math pieces that come together. Allie's going to walk you through the outputs and the actual impact on the RSIC portfolio.
Great, thanks, Leroy. Yes, I'm going to shift gears now. So Leroy obviously talked about the process that we conduct in order to come up with a lot of these expected returns. And I'm going to talk a little bit about the output. So as you can see on page 11, we have the 2021 expected return for all of the various asset classes, starting with fixed income. And then in the next column, we have the 2020 expected return. So what you saw last year from us. Then you see the change over the past year and the resulting impact or the reason for that change. So as you can see, pretty consistently, we've seen a decline across the fixed income asset classes. You can see investment grade bonds have gone from a 3% expected return to a 1.8% expected return. TIPS have gone from 2.9 to 1.8%, and high yield bonds have gone from 5.2 to 4.2%. The vast majority of this is driven by lower yields. As you can imagine, we continue to see rates decline in 2020, so are left with a more expensive fixed income environment than we had found ourselves previously. And in addition to that, we've seen tighter spreads within high yields. So we ended the 2020 year with a high yield spread of 3.6%. Versus historical average of 5.4%. So indicating that you're not getting paid for taking on that risk at the same level as you have historically. As you look further down, you'll see private debt, which has a much less of an impact relative to the other fixed income asset classes, but also modestly impacted by lower yields in this environment. Further down, you'll see equities. And again, this is, as Leroy mentioned, one of the driving factors as we look at forward-looking returns for each asset class's valuation. And after coming off a 10-year bull market, or over 10 years now, in the equity market, we continue to see high price to earnings ratios, lower dividends, and valuations continuously being stretched out of all segments of the equity markets. You'll see emerging market equities declined by the most significant margin relative to developed market counterparts in U.S. equity, declining 1% over the year with respect to our projections. This is partially driven by some of the run-up that we saw in the fourth quarter in the emerging market equity returns. You can see private equity also declined, but much more modestly, similarly to private debt. They are impacted by the higher prices, but this is partially being offset by lower borrowing costs. So obviously with interest rates at historical lows, private equity is able to leverage that to their favor. And you'll see that theme kind of carry through amongst a lot of the private markets asset classes where they're assuming leverage and benefiting from some of these lower rates. If you turn to the next page, page 12, you'll see real assets. Real estate came down due to lower cap rates. And you can see at 6.9% in aggregate relative to last year where we were projecting 7.5%. And by core real estate, which came down roughly 80 basis points. Value add came down about 70 basis points. And then REITs were up due to the higher yields associated with REITs at the end of 2020. As you look kind of further down, you'll see infrastructure. Again, similar negative impact amongst infrastructure within the public segment, down 10 basis points. And then you'll see similarly down 10 basis points for non-core private. We did see core private infrastructure come up just slightly as a byproduct of lower prices and lower borrowing costs. Prices were obviously driven down partially due to the implications of the pandemic on some of those infrastructure assets. Then you get to your alternative strategies, and again, pretty consistently negative in terms of the impact to return assumptions. You can see hedge funds down 60 basis points relative to our projections last year. TAA or tactical asset allocation strategies down 30, risk parity down about 140, and inflation came down about 50 basis points. So that kind of summarizes where we are with respect to each asset class. I'll jump to page 13, and I think this is kind of an important slide to hit, and I think you've probably seen it before, but as you might know, Horizon Actuarial Services conducts an annual survey to evaluate large investment advisors and consultants in the industry with respect to their capital markets assumptions. And so you can see the 10-year average and the 20-year average that they have produced from these surveys. And then you can see Makita's 10-year and 20-year return assumptions next to it. This allows you to compare. In essence, it allows you to feel comfort in the fact that our return expectations for the various asset classes are pretty consistent with our peer group. This is a survey of 39 various firms. And you can see that, while there is some deviation, nothing is drastically different than our peer group with respect to the 10 or 20-year averages. The other takeaway as you kind of look at this chart, or this table rather, is that pretty consistently amongst both Makita and our peer group, you're seeing the 10-year returns being significantly lower than to 20 years. This is because we recognize that the bull market that we've found ourselves in pretty consistently has allowed us to kind of borrow returns from the past and push them forward into the future. So you guys have benefited from strong equity markets over the past 10 years, much more so than expected. And so as a result, kind of in terms of mean reversion and kind of averaging out over time, we anticipate the next 10 years will be much lower than the prior 10 years or the subsequent 10 years. So over the 20 years that neutralizes, and we expect you to get back to a pretty consistent positive long-term return. However, in the short term, we think that it could be a bumpy road for equities particularly. The next page, page 14, just kind of highlights some of the risks that we're seeing in the market. If you look at the blue line, you'll see the expected return and risk of the various asset classes charted in 2011. And then the green line shows the corresponding asset classes charted in 2021. The key takeaway here is that in order to earn the same level of return, you have to take on significantly more risk in this environment. So you can see that the expected return has fallen, but the risk has stayed the same for the vast majority of asset classes. So we recognize that it's definitely a key indicator as you look at some of the return expectations that we talked about, and it is forcing people to explore various forms of risk in their portfolio and be as efficient with taking risk as possible to earn your long-term return expectation. So with that, the final page that I'll hit is page 15, and this really gets into the details of your portfolio. So you can see your 5 asset mix policy, your 5 asset mix with portable alpha, and the reference portfolio listed in the top table and their corresponding allocations consistent with your SIOP. And then if you look further down, you'll see the corresponding impact based on our 2020 expected returns. So you can see the 5 asset mix is expected to drive 6.56% over the next 20 years based on the 21 expected returns for the various asset classes. This is down about 60 basis points from what you experienced last year with 7.22% expected return. You can see the standard deviation or the volatility measure has increased a bit as well. And then you can see the probabilities of achieving 7.25% and 7% have also come down consistent with the reduced expected return of the 5 asset mix portfolio. Those themes carry through for the 2 other portfolios shown, the 5 asset mix with portable alpha and the reference portfolio. But we do think that the portfolio is very well designed, takes on a prudent level of risk. And while these numbers are alarming, I would say, in terms of the reduction, I would say that they are median returns. So they don't incorporate any alpha derived from active management. And so to the extent that your portfolio can outperform their respective benchmarks or your active management can, particularly in the private markets, we anticipate you could derive a significant premium over that 6.56% with alpha. So I'll pause there, see if there are any questions, and if not, turn it back to Mike.
Does anyone have any questions?
This is Ron speaking. I just wanted to ask if your projections for the future of private equity are able to take into account the fact that this investment space seems to be becoming more crowded and more active than it was in the beginning of the private equity era.
Yes, it absolutely does. And our private equity expectations are pretty are kind of diversified across the market cap spectrum within private equity. So it incorporates some of those large mega funds as well as middle market and smaller market opportunities that may be less capitalized on by large institutional plans. And so I think that we do recognize within our capital markets assumptions the potential impact that increased investors have in all of the spaces, including private equity, the potential efficiencies that are coming into place in various segments of the markets, and use that as kind of a little bit of the art that goes into refining the capital markets expectations after using a lot of the data. So as Leroy mentioned, it's partially art, partially science when we're coming up with these return expectations. And so then they are fine-tuned kind of based on our forward-looking projections of the ability to capitalize or take advantage of various markets and the efficiencies that are embedded in them.
Thank you.
Thank you.
Any other questions for our folks from Makita? Hearing none, thank you both.
Thank you for the time.
Yes, thank you.
All right. Next up is the CEO's report, but I'm going to suggest that we take a 10-minute break. My phone says 11:07, so we will reconvene at 11:17 in 10 minutes. All right, everybody take a break. Hello, everybody. It's 11:17, and we're back. This time I'm going to turn it over to our CEO, Mr. Hitchcock, for his report.
Thank you, Mr. Chairman. The next item on the agenda is the presentation of the AIP SIOP, and I will be going through the changes. I'm going to try to do this rather expeditiously. If possible, please stop me if you have any questions. I'm also going to go through the our marked up version just so we can see the changes on the screen as I go through them. I think as everyone is aware, we'll present this at this meeting. Of course, take any comments, suggestions, or ideas from the commission here, and in the interim, in between now and the April meeting, we will come back then with a final version of this to present to the commission to hopefully approve, because we're statutorily required to do so by May 1st of each year. So that being said, like I said, I'm going to try to run through these real quickly. I'm going to try to hit as most of the changes, even though the vast majority of these changes are small in nature, or they are an effort to potentially provide a little bit more context to some of the work that we did last year on the reference portfolio and the policy portfolio. I would submit that there really are no substantive changes that we are recommending, especially to the policy portfolio. So page 4, this a real simple change, just updated the funded status of the various plans to coincide with the actuarial evaluation. Page 5. On this page, it's indicated that the assumed rate of return is scheduled to decline to 7% at the beginning of the new fiscal year. And also, I deleted a reference to 7.25% and just said that exceeds the assumed rate of return, so that we didn't have to come back and change that every time that the assumed rate of return changes. So not really a substantive change there. The next, page 6, we updated table 1 to correspond to the return to last year's return and impact on the portfolio. We did bring this forward to 12/31/2020 versus the end of last fiscal year, because we thought that better coincided with the capital market expectations, given the capital market expectations are more on an annual basis. So you can see the impact to that overall. When we think about the base case scenario to reaching fully funded status, we updated that on page 7, and that the base case scenario to reach fully funded status increases to 4 years. Also on this page, I updated the projected amortization schedule for SCRS and PORs, and also added a footnote that the way that I read the actuarial evaluation is that the GRS really provided 2 amortization periods depending upon whether or not the General Assembly increases the contributions by 1 or 2%. Page 8, updated table 2 in the same fashion as table 1 with the updated return expectations. Also, on page 9, included some language that acknowledges that the base case scenario for reaching fully funded status and for the contribution decreasing has been extended, but that even though that it's been extended, that if we went back to the 2020 analysis, where we are would be contemplated by that analysis. So moving on to page, what is in the marked up version is page 13. I wanted to indicate that when we're talking about the purpose of the commission, we had an indication up there in the first paragraph that the commission doesn't expect to change the portfolio to react to short-term market conditions. I added some language about frequent fluctuations in capital market expectations as well. Down at the bottom of the page, I've made it clear that when we were looking at the reference portfolio and adopting the reference portfolio, that was intended to be a risk reference, a risk barometer, and not a risk limit for the policy portfolio or for the actual portfolio. On page 14, added some language trying to provide a little bit more. This is at the suggestion of Mr. Condon, trying to add a little bit of some context to when we developed the reference portfolio, that we understood that setting the reference portfolio with a allocation to 70% equities put us at the if we were to actually have that portfolio, would put us at the maximum allowable allocation to equities, but that we felt that it was necessary to set that or to constrain the reference portfolio to no more than 70% equities, because that was the amount of risk that was necessary for a diversified portfolio of assets that we would expect to exceed the annual rate of return, assumed rate of return, and also have a no greater than 5% probability of requiring additional contributions increases over the next 5 years. So moving on to page 15, I just added you'll see the gray area right there. I just added that to indicate that was the area that we were contemplating as where we would think that the reference portfolio, portfolios that would potentially make up the policy portfolio. Let's see. Page 17. I added, and this is again, in talking to Mr. Condon, and he felt that it was a good idea to add some language, and I agree, really trying to explain what the role that each asset class plays in the portfolio. And really, when we think about it, is that there's for many of the asset classes, there's a primary role of growth, diversification, or yield, and some of the asset classes also serve a secondary role of one of those three. But we added that language, so that's the language that you see there. Moving on to page 19, I updated the return expectations based on the 2021 capital market expectations, the return expectations, the volatility, and the probability of exceeding what should be 7% assumed rate of return at the beginning of this fiscal year to this part of the document. I also added some language explaining why the commission would believe that this decline in expected return doesn't prompt the commission to make a change to the asset allocation, and doesn't really move it to depart from the discipline that we've set to review asset allocation and consider asset allocations every 5 years. I will be honest, I am not necessarily in love with this language and doing it this way. I think that, you know, as I've thought about it and considered it, I believe that this language really creates or compels us to create or to provide an explanation or as to why we don't think that we should take action, rather than really, I think that the onus as long-term investors, the onus on us to depart from a discipline on asset allocation, really that we should have, the onus should be, or the presumption should be that we don't take action, and the onus would be to demonstrate why we should take action in regard to asset allocation. So it's, you know, it's in here. It's not necessarily, like I said, as I've kind of gone back and looked at it again, I'm not sure that this is the best place for this update. I think this may be something that we could put in the appendix, you know, a lot more as we are doing with the updates to the various tables that we have. But you know, that's an item, that's something for consideration.
Mike, this is Bill.
Yeah.
I have a question.
Yeah.
Is table 5 the one I always refer to with that little triangle, gray area triangle? Has that been updated since last year's?
Yeah, I'm going to show that in just a minute, Bill. Yeah,
okay, thank you.
I want to get through these, and then we have that. Yeah, that's in the bread number document, so I'll show you that in just a few minutes.
Thanks.
Yeah. Moving on to page 21. Just I added language clarifying again that the reference portfolio is intended to be a risk barometer, not necessarily a risk limit, but that it is a, you know, that when we think about those, how the reference portfolio and the policy portfolio and the implementation portfolio, you know, we will, one of the three will have that those risks ultimately will diverge over time. You know, sometimes the reference portfolio will have a higher risk, expected risk than the policy portfolio, like we see in the return expectations that we have now. But really, what we would think about is over time that they would generally move up and down together. So. Next on page 23, and when
Mike, can I interrupt?
Sure.
One more time. Thank you.
No problem.
This whole thing about risk, I know you and me and Jeff have talked about it many times. As Makita's presentation just showed, with the new expectations, the volatility of the reference portfolio is 12.75, the policy portfolio 12.52. So the policy portfolio is a little less,
yeah,
I guess because of diversification. But then once you add in portable alpha, it's 13.32. So a pretty good jump from the policy and the reference. So, and I know you've talked about the reference being, the risk of the reference portfolio being a barometer, not a limit. Is there any kind of limit? I mean, my thinking is maybe as the board, we need to consider a limit or at least express how we're going to, how and when, how often we're going to assess the risk and whether it's too much. So anyway, so I guess one of my questions is there really any kind of limit to risk, and how are we going to assess that periodically?
Sure. Bill, this is Jeff. The way I think about that is the commission has communicated risk limits, not in setting a nominal value of the standard deviation that is the limit, but has communicated it in a different way, which is, making it clear to me and to the staff how far away from the policy benchmark we are allowed to stray. Does that make sense? It's a different way of limiting the risk, and it's done in more prescriptive terms in terms of what can we actually do to the portfolio.
You mean the target ranges?
Yes, the ranges are. Yeah, I think of the target as the number and the ranges as the bookends around that. So that in effect is a very practical risk control. I'll tell you the concern that I have around choosing a volatility level. And then, because I'm going to show you risk statistics later today. So let's say you choose 14%, but we go through something resembling the financial crisis. The target, the reference portfolio, the policy portfolio, and the actual portfolio would very swiftly blow through a risk limit designed for normal times or designed for an overtime perspective, because volatility can scale very sharply to heights that would just render that to be, we would have no choice but in a downturn to go to cash in essence. And I don't think that's I don't think that is the appropriate functional goal of a risk limit.
Yeah, and you think about that, Bill, what's causing that spike, what would cause that tremendous spike in vol would probably be a significant impairment to asset prices. So in order to shed that risk, you would probably be selling, it would encourage you to sell the asset that was the most impaired at the most, so you'd be selling it at the most inopportune time. And, when those asset prices are impaired, that is a opportune time for us actually to add risk in the form potentially, like in just a simple 70-30 portfolio, that would be an opportune time for us to, diversify or to rebalance into equities, where, sell, because you would sell bonds to rebalance into equities, and versus you're selling equities in order to shed risk.
Well, if we didn't set a risk limit, a hard and fast, a static number, but we did it based on the policy or the actual portfolio's risk compared to the reference portfolio, and they all move, would that reduce your concern? Because the reference portfolio is going to go up as well if volatility is going up.
So, well, let me introduce another kind of practical impediment to this. We see risk, and we measure it, but we are not seeing and measuring it in real time. We have to settle on a methodology. Our methodology is we are looking at a trailing window of 2 years. We could set it up any way we wanted, but we have to have an ability to reliably measure that and have that create kind of prescribe certain actions. And to me, the concern that I have is you set something up like that and it could become rote. When this happens, we take this action. And personally, I think that it's hard when you set it up around the concept of a risk limit. My instincts tell me when risk has risen to a very high level, I have a calm that comes over me that I don't normally have, because I know that I have tremendous opportunity to make long-term decisions from a moment in time where there is weakness in capital markets. And that's the, you know, the old saying, the ice in the veins. You know, that's what you have to have if you're gonna use those opportunities to make decisions. Now, I don't know. Kind of, we're talking in kind of conceptual, but I think cause and effect way about this. I don't know that the concept of establishing a risk limit makes that easy to do. And I guess, you know, I would put it to the commission. I mean, to me, the goal would be, we want to have, you know, we want our portfolio to put us in a position to take advantage of those moments, and B, to ensure that we have the liquidity to take advantage of those moments. But doing that at that point in time ultimately winds up being a judgment call. And if we overlay you know, we can do that, but for the fact that if it pushes us up in risk at a moment when risk has already been elevated, I don't know if that winds up leaving those opportunities available to us.
Right,
Does that make sense? I'm just trying to think through it in real time.
And I definitely appreciate your comments. I guess I'll just ask one more question. And of course, this whole thing is kind of based on my concern that we're starting off at the reference portfolio with a very high level of risk, that 70-30. So going much higher, is more risky. But my last question is, you mentioned the way y'all measure or kind of use, and I might mess the words up a little bit, but the way you measure risk is this 2-year trailing. But that's inconsistent, or is that inconsistent with the way we look at risk when we're setting the reference in the policy portfolio? Because we're looking at a forward 20-year.
Yeah, you're looking at prospective
20-year risk. So that there's some inconsistency there, and I think at a minimum we should be looking at the 20-year assessing risk, maybe annually when we do this SIOP at the 20-year to see if there's a big picture event that makes us need to look at it again.
Bill, our understanding of the risk statistics that you were just looking at is Makita's discipline on how they model risk is actually has more in common with what I described than you might suspect. But it relies on the principle that they argue over long periods of time. I think risk tends to be pretty homogeneous. So those numbers are driven, and Leroy and Allie, correct me if I'm wrong, based off of the last 15 years of volatility in each of those markets. So what you are looking at, even though, but that is a really, has historically been a good proxy for a long-term look forward for risk as well. So our 2-year window is more of an attempt to be thoughtful about what is risk in the current environment. But of course their mandate when thinking about 20-year returns and risk is to kind of give you that longer term perspective. So there's some commonality, but there's a different lens that they're trying to look through. Is that helpful?
All right. Yes, thanks, and thanks for everybody indulging me.
Happy to, Bill.
Yeah. So, like you think about it, Bill, if we're looking back, if you think they're looking back 15, that's going to smooth out a lot of that variance, right? But if we're looking back to, and I mean, then that you're going to see a little bit more divergence, I think, easier over the 2-year look back. So, but over periods of time, like we said, we would expect these portfolios to move up and down together, and at times one's more volatile than the other, right? So if there's any other questions about that, I'll move on to page 23. And these are the strategic initiatives. And what you see is we've taken 2 of these off of the strategic initiatives for the upcoming year. We have fully implemented the asset allocation, the new asset allocation, and also we've removed the co-investment program and really this is a consideration of whether or not we should move that into a kind of beyond private equity and into the other asset classes. We're getting a deep dive on the co-investment program in executive session pretty soon. And that you'll see where we are on that. So we don't think that that's something that we need to push forward into the next year. So we have 4 initiatives that remain, certainly open to any additional strategic initiatives that the commission would like to see us concentrate on over the next year or so, if there are any. Moving on to page 25, what I did there was just, we have baselines for each asset class. We review those. I made sure that we indicate that we review those baselines and update those as necessary, at least annually. And we're reviewing those baselines for each asset class with the commission for the particular asset class in the 5 asset class portfolio when we do the deep dive. Page 26, we removed GTAA and other opportunistic strategies as a potential asset class. We do not see the need to maintain that as an optional asset class for us moving forward. On lower down on the page, you'll see that there's previously been a notification provision to the commission if our collective exposure to private equity, private debt, and private real assets exceeds 25%. We moved that to 30, or proposing to move that to 30, just because if you add up all of those exposures, so if we're at target, then we're at 30%. So we felt like if we exceed that, then that would be the amount to notify. But we also took down the maximum exposure to hedge funds from 20% to 15%. We don't feel like that there's a need for us to have that much discretion when it comes to hedge funds. And on page 34, just indicated, and this section is what we review with you at each meeting, so that we are in compliance with the statutory requirement for us to review what we're required to review on a quarterly basis. And instead of just reviewing the progress of the strategic initiatives at every meeting, we just put that we'll review relevant progress, because sometimes there's not necessarily significant or relevant progress for us to review with you. So, and that is, I believe, the extent of the proposed changes at this point.
Bless you.
I'm certainly willing to answer any questions.
Mike, this is Ron. If you could go back to the point about hedge funds and the maximum percentage of hedge funds. My question about that is, at the present time, are we only using hedge funds in the portable alpha part of the portfolio?
Yes, sir.
Thank you.
Mike, were you going to say something about table 5?
Was. Yes, I was just seeing if there's any questions about this, but yes.
Oh, okay. I'm sorry.
Okay, I'll move on. If there's no other questions on the changes, I will move to show you where we project. The table 5 that we're talking about is this table. This is where, when we were projecting, when we were doing making the changes to the asset allocation, we were trying to map the portfolios, what was then the simple portfolio and the then existing 18 asset class portfolio. And we were trying to shoot for a 5 asset class portfolio that we believed would, in essence, land in that gray area but it would exceed the assumed rate of return. It would be as close to the efficient frontier as possible, but it would also avoid, it would have less volatility than the 70-30 portfolio, but would also avoid that red risk line. And that red risk line is if you're to the right of that red risk line, then you have a greater than 5% probability. The portfolio has a greater than 5% probability that contributions would have to be raised within the next 5 years. You stay on the other side of that, then obviously that's a less than 5% probability. So we set that as a risk line. There are, when we were reviewing this, there were other inherent risks that we could have mapped as well. But those risks would have been to the right of this red line. So this red line was the furthest to the left. We've updated this table just for information purposes to see where we are. And where we are now, the kind of this gray area that we would be targeting, that's what we see is because of and this is based on Makita's return and volatility and correlation expectations. What we see is that gray triangle has moved even to the right of the 70-30 line. If you see risk line, if you see the diamond that's the blue diamond that is to the left and along the blue dotted line, that is the return and risk expectations of our 5 asset class portfolio. As you can see, it's interestingly enough right on that blue dotted line, which we think is the peer median based on what we can derive from the asset allocations of our peers. We're certainly understand that it's below the red dotted line, which is the assumed rate of return. When we add in portable alpha, that gets us, more vol, but also more return, gets us closer to that gray box. We feel pretty confident that the way that we're implementing the portfolio now, that we would be pretty close to either at or pretty close to that kind of the left corner of that triangle. So hence, again, we're not recommending any change to the asset allocation. So, but this is where are we doing this exercise now? This is where we would be doing the asset allocation exercise. Any questions about that?
So is this going to be in the SIOP?
No, because this isn't what we were considering. I don't think that this necessarily has a place in the SIOP because this isn't what we were considering at the time. This is just where it is now. It's informational, but it's not, I don't think it's really pushing us to make any type of decision. So.
Okay.
All right. Any other questions? That being said, I will move, again, hopefully expeditiously through the next portion of my report. Whoops, sorry. The Ed Giobbe asked that I give the commission kind of a general, we've had a lot of, over the past, 5-6 years, especially over the past 3 years, especially since the pension reform bill, there have been a lot of changes to our governance. So I'm going to run through a presentation on where we stand now on governance and accountability. Always willing to answer any questions about any of this. This is a lot of this information is we regularly present on to the audit committee. But both Ed and I agreed that it was probably a good time just to review this. So I'm certainly willing to answer any questions as we go. As we know, we'll start out with the commission. As we know, the commission was created in 2005. The purpose was given the exclusive authority to invest and manage all the assets of the state's 5 DB plans. And really, and we went with the 2017 legislation, we went from 7 commissioners to 8 commissioners, with the governor now having 2 appointments to the commission. There was also some other changes that were made to terms, and there were term limits were put in place. But if you think about the primary purpose of the commission is really to set the strategic direction for our investment program now. And what we're trying to do is we're trying to earn a return that, when we combine that with contributions, provides benefit payments to current and future retirees. And you see that the commission is responsible for setting the long-term asset allocation, exercises oversight of both the investment function and the business affairs. Even though you have delegated investment authority to the CIO and staff, you do retain the authority to approve certain investments above those limits and certain other contingencies. You ensure our legal and ethical integrity and make sure that we're accountable, and you adopt really our governance policies and define the roles of the disparity between the commission and the staff. As for me, I am employed by the commission. I am set as the primary figure of accountability for the commission. So that means whenever somebody's called to come across the street, and that's usually me, it's my job to carry out the commission's mission, policies, and directives. By statute, I am delegated all of your authority to manage RSIC and to implement your decisions. I'm responsible for hiring the chief investment officer and all the other staff who serve at the pleasure of the CIO. I exercise direct oversight of the CIO and other staff, and I also have the final authority to close investments. CIO, he's employed by me, he or she. As we like to refer to Jeff as our current CIO. It's Jeff manages the investment function and the staff of the investment team. He's responsible for the allocation of capital primarily to external investment managers. And really what we're trying to do is provide exposures that implement the asset allocation. Jeff has delegated the final authority to invest within certain limits. He manages exposures also of the portfolio and rebalances, especially through rebalancing, and really is responsible for overseeing investment risk management and investment manager oversight. We do have some primary staff committees. We do have an executive leadership team that's composed of the CEO, the CIO, the COO, and the CLO. That's a lot of alphabet. That the executive leadership team serves as our primary management committee and really is responsible for helping me make strategic, organizational, and operational decisions. One of the most significant staff committees that we have is the IIC, the Internal Investment Committee. They're appointed by the CEO with Jeff as the chair, and their primary purpose is to vet and recommend new investments to the CIO for approval. They also advise the CIO when we think about our setting our asset class baselines, and that's the forum by which we debate any changes to those baselines. Internal audit and ERM and compliance, the internal audit function, it's governed by the Commission's Audit and Enterprise Risk Management Committee, and its job is to provide independent and objective assurance and recommendations to improve our operations. We do employ a co-source model where we have a dedicated internal staff resource who's responsible, though, for coordinating the activities and of Deloitte, who is our external resource to actually conduct audits. As far as ERM and compliance, my goal for, as I've told ERM, my goal is I want ERM to mitigate all of the organizational risk that we don't receive compensation for. We understand that we get paid by exposing assets to risk, but we don't get paid for organizational risks. We do have a dedicated internal resource. They aid me and the management, other members of management with trying to mitigate risk. And this internal resource also manages compliance with our internal policies and all applicable laws. One of the bigger aspects of this that we've been able to bring online of ERM is we've developed an ERM dashboard, which gives us a ready visual all on one page, the various enterprise risks and of the organization and the ones that we should be paying attention to the most. And we're currently developing both key risk indicators and key performance indicators for all of those risk boxes that we see on the ERM dashboard. Just also wanted to go over some additional improvements that we've made over the past few years that I think have really helped governance and making us more accountable. Our capital call, we brought on our capital call management service. This is a service that we have through BNY Mellon, where we really centralize our capital calls. And that is, has given us a great deal of assurance that we are sending cash to the right folks at the right time. As I've said, this is one of the bigger risks that I felt that we needed to mitigate, because we don't have to send what we would consider to be a significant amount of money to the wrong person for it to be a really big headline. We believe that through that and the other improved cash movement processes that we've been able to mitigate that risk. We have outsourced the cash and short duration management. We used to do that internally. We have outsourced that now, which has cut down significantly on enterprise risk. We believe that the portfolio simplification has not only reduced the active investment risk, but has also allowed us to shift the organizational focus to the parts of the portfolio that we think can really provide us consistent excess return. We would submit that the performance reporting framework provides the commission with a much more look through into the portfolio and the ability to judge investment decisions and breaks investment decisions into more parts and provides a greater ability for the commission to exercise oversight. And the long-term perspective that we set of reviewing the asset allocation, especially every 5 years, we believe will benefit the portfolio and performance. So certainly willing to answer any questions about any of this. I've moved through it rather quickly, but if anyone has any questions, certainly willing to answer.
Questions for Mr. Hitchcock? Hearing none, let's move along and now receive the report from our CIO. Mr. Berg?
All right, let me get control here. Okay. Thank you, Mr. Chairman. Before I get into our performance, I just want to say how proud I am of our people and the dedication that they've shown to our plan participants in what was, to say, I think the very least, a extremely challenging year. I do think our people did some of their best work in 2020, whether it was creating $13 billion worth of trades to rearrange our portfolio for the new fiscal year, balancing our hedge fund portfolio, or finding and executing on so many compelling opportunities for our private markets portfolio. The way I look at it, we were able to plant a lot of trees during a storm that will bear fruit for years to come. So I just want to make sure I say that up front. I'll go quickly here through performance. As you can see here, we had a very, very good quarter. Plan was up 10.4% and well ahead of the policy benchmark. Through 6 months, we're up almost 16%. In a few minutes, we'll break down the excess return here. And I do also want to point out that at the end of the calendar year, the portfolio value was $35.6 billion. During the first half of the fiscal year, we had net benefit payments of $289 million. Here we see some additional detail behind the change in plan value. One thing I do want to make sure I flag here is we did receive the $110 million legislative inflow that we have received for the last couple of years. And the other noteworthy response to a question I got is on the right-hand side. You can see that 15.9% equates to a $4.9 billion positive impact to the plan value. So I am going to skip this page because we are going to see it again in a few minutes. And I do want to make sure that I report for the record that all of our exposures were within the ranges permitted in the SIOP, so we are fully compliant at 12/31. Now, let me dig into the quarterly performance, if I can get through the footnotes. So obviously a 10.4% return for a quarter is quite good for the system. We outperformed our policy benchmark by 1.66% in the quarter. But let's just dig in our customary way into the impacts that occurred in the quarter. As a reminder, our framework highlights 3 impacts for us, and these are featured in the middle row on this page. First, we have the impact from employing a diversified investment strategy as opposed to a simple 2-asset portfolio. Second, we have the impact of decisions that we make to look different than that diversified policy portfolio. And then the third is the impact of manager selection. In essence, how well did our managers execute for us during the quarter? So first, we see here that not only for this quarter, but this is a story of the last several years, the value from diversification is negative. During the quarter, the story there is very simply that global equities earned more than 15%, and that makes it a tall order for a diversified portfolio using other assets to beat. Quality of portfolio structure, the decisions that we make to look different. You can see that the impact over all time periods is positive here, but I do want to make sure I point out it is being driven by some very strong recent performance. And then third, the manager selection impacts, positive in the quarter. Longer term impact, though, still negative. If you recall, a good portion of our adverse experience came from a few asset classes and strategies that are no longer a part of the portfolio since June 30th. So let me shift forward. This is the simple summary. What worked well, what didn't work well, what was sort of in line. The story's very simple. This is almost a carbon copy of what we were talking about 3 months ago. Our portfolio has been positioned for the recovery to continue, and the recovery has continued. We were underweight core bonds, overweight public equity, and various forms of credit. Our portable alpha portfolio has just been performing exceedingly well after a tough year last year. So this is very much a return to where we need it to be. We also saw a significant rebound in listed real assets, and I'll have you think listed infrastructure and REITs. Both of those components of our portfolio performed very well and significantly outperformed our private benchmark. This is I almost laugh saying this, but the one main driver of underperformance in the quarter was the fact that we were overweight private debt. And I suppose it is a sign of a phenomenal quarter when our negative attribution is coming from being overweight something that was still up over 4%. So chalk that up to it's a good problem to have. Let's look at the impact of the portfolio structure decisions. These are the top-down decisions that I just described. But here you can see the magnitude of each. And this is impact to the plan in basis points of return at the plan level, not the asset class level. So during the quarter, hedge funds gave us the biggest single impact, followed by the strong recovery in the REITs and the listed infrastructure. Here we can see the manager selection impact. Almost every asset class outperformed in the quarter. Our bonds portfolio gave us the single biggest impact in the quarter. And again, think of that as being invested not just simply in core investment grade bonds. This is where you see the impact of continuing to hold some of the exposures that got beaten up last year, like high yield, non-investment grade bank loans, and emerging market debt. This graphic shows us the last 4 quarters of the cumulative attribution effects. We had obviously a very frustrating first quarter last year, but since then we've seen value in continuing to be positioned pro-cyclically for the recovery. I do want to slow down on this one for a second. I want to spend a minute here on the 3-year, next one, on our 3-year numbers. And I think it's most useful to think about this in context of some decisions we've made over the past few years. I'll start with the public equity line. You can see there's underperformance over 3 years. We made the decision last year to go passive in the public equity book. You can see, obviously, we weren't getting the outcome that was acceptable to us in light of the cost and complexity that we had in pursuit of excess return. So by going passive, we know that our outcome in the future is going to be considerably better than what we're seeing here on this page. This change, I should point out, alone, this change accounts for roughly half of the gap that you see between total plan and policy benchmark. So this change alone makes up half of that gap. The second thing I want to point out, in our bonds portfolio, the trailing 3-year return is skewed by my decision to be overweight cash and underweight core bonds in late 2019 into the COVID-19 onset crisis. This is something that hurt pretty badly, and you see it here in the underperformance, because you're looking at a composite that includes cash that we are holding, net cash that we're holding. Later on, Brian is going to give us some additional detail in this area. Next is private equity. We're still seeing some pretty significant negative effects from having undercommitted to private equity as an asset class between 2012 and 2017. But in the last 3 years, we've picked up our pace of commitments, and we have had a special focus on our co-investment program, which we will also discuss. And that co-investment program is very rapidly becoming a bright spot for us. Private debt, this is the story of a portfolio that is converting from one that had a very aggressive, opportunistic approach to a portfolio where our goal is to consistently outperform listed credit markets. So if you think of that, we had been shooting for a magnitude of excess return. We are converting this into a portfolio that seeks to provide a persistence of excess return. So during the past year, the benchmark has fluctuated wildly, which makes this a more difficult story to see. But I can already tell that the investments we've made over the past 3, 4, even 5 years are delivering on this vision. So as the legacy portfolio diminishes over time, I do expect this message to start coming through in these numbers. Real assets, what can I say? That's a portfolio that just keeps humming along, doing very well. And the last thing I think is worth discussing is our Portable Alpha portfolio. This is a portfolio that you wouldn't necessarily know from just looking at the numbers, but has undergone quite a transformation. Brian and Justin have really been focused on portfolio design and rethinking this portfolio so that we can expect to more persistently earn that return, that 3 to 5% return over cash. So I wanted to slow down there and kind of talk to you about these returns in context of the decisions that we've made during this 3-year time period to create better outcomes. Here we're looking at our exposures at the plan level on 12/31. All of our active weights I regard as relatively modest, but still consistent with the theme of continuing recovery. Let's drill in a little bit. This is not a terribly interesting slide, and frankly, that's the point of it. This is our equity portfolio. We do have some small legacy equity investments in the overlay that will roll off soon, but those are preventing us from being completely aligned with the ACWI IMI index. They will roll off over the course of the next few months. And as you look at this same slide in the future, if I wouldn't think it's possible, but it's going to get even more boring. So let me move to our bond portfolio. This is where you see, in 2 ways, you see this portfolio reflect a continuing bet on the recovering economy. First, we're underweight the asset class by 2%. And second, the exposure we do have does include high yield bank loans, emerging market debt, and some floating rate exposure. And while we have been slowly reducing the credit exposure, we have been slower to add the core bond exposure as rates have just been grinding higher for several months now. We have recently begun to add more core exposure and benefiting from missing the last 6 months of rising rates. Let me close on our risk slide. These are our risk statistics as of December. And I'm going to tie this back to something we talked about a few minutes ago. The portfolio positioning that I just described, along with our use of Portable Alpha, is the cause for the implementation benchmark and the actual portfolio to show us that they have higher risk than the policy benchmark. I alluded to earlier, our methodology is one that looks at the volatility of these portfolios over the last 2 years. If we were to look at the exact same portfolios at a different point in time, we could see a different relationship between these numbers. And I looked at some work that James Wingo provided me. And if we were to look at this chart anytime between late 2010 and early 2016, and thinking about the boxes on the top row, it would have been the reference portfolio that would have appeared to be the riskiest of the portfolios. So I just wanted to share that with the commission. And let me pause there to see if there are any questions.
Questions for Mr. Berg?
No, no questions. I'll just make one comment just because, you know, core bonds and bonds in general, right? I mean, I think I would just encourage you to really, you know, I know from a policy perspective and the role they play, but right, I mean, the 10-year realized inflation, I'll just point out, is 1.6, and that's before we've gotten all this money we're throwing at the wall right now. So just like, even though they've spiked up, I mean, effectively the whole 10 years and under is still below on rates, right? And obviously you've seen credit sort of improve with the economy, right? But at some point, you know, there's only so much room they can compress, and the whole curve is still under the realized inflation rate with numbers going up, not down anymore, right? You know, and obviously volatility stays up at these rate levels, right? So just in terms of your trading with it, right, your vol is going to be higher on the asset class.
Agreed.
Thank you, Alan. Any more questions or comments about the quarterly investment performance update we've just received? Hearing none and moving along, I'd like to now move to the delegated investment report. And again, we'll go back to Mr. Berg for that presentation.
I apologize for what I'm doing here. Okay, so this is just our discipline is we reveal the investments that were closed pursuant to the authority that I have to approve investments. And you can see here we have 5 private equity investments and 1 private debt investment. So. And
Any questions for Mr. Berg on the delegated investment report? Hearing none, I will now ask Mr. Hitchcock to read the motion for us to enter into executive session.
Thank you, Mr. Chairman. The motion would be to move to executive session to discuss investment matters pursuant to SE Code sections 91680 and 916.320, including a comprehensive review of the bonds portfolio performance and a discussion of various underlying holdings, a review of the co-investment program's performance and discussion of various program investments, and a review of potential investments in the due diligence process, and to receive advice as needed from legal counsel pursuant to SE Code section 30-470A2 related to potential investment matters.
May I have a motion?
So moved.
I have a second, please.
Ron seconds.
Thank you, Ron. Any discussion? Hearing none. All in favor of moving to executive session, please say so by signify by saying aye.
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 Is there any opposition? The ayes have it. We are now in executive session. Thank you very much for folks who will be dropping off now.